Of course, by now you've probably heard the news of the passing of Charlie Munger. Rest in peace to a true legend. He's a guy that many of you know I've followed for quite some time, so my heart is sunk a bit tonight, and just want to tribute him the best that I can, and that is to continue learning. Of course, that is one of his big things, but we are thinking of Charlie here tonight. We're thinking of his family and Warren and all of his other close associates out there. A very sad day for the world of business. But we must press on. As usual, we're going to be doing our market outlook video here tonight to kind of review what took place within the markets today. It was a quiet day, not a whole lot to report, but many of the key trends that we've seen recently with interest rates falling, oil prices falling, and the US dollar somewhat weak, once again supported stock prices. We did see a big burst in the emerging markets that we'll talk about here tonight as well. So let's go ahead and get into it. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 28th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel. Then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also see which stocks are giving you overbought and oversold cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of X, formerly known as Twitter. If you're not doing so already, I would encourage you to follow me. My handle is @BrandonVanZee, and we really appreciate those of you that click like and retweet with this Market Outlook content. And then last but not least, we do have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And I'm sure most of you have found out by now, but just in case you haven't, we heard the sad news this afternoon that Charlie Munger, of course the co-chairman at Berkshire Hathaway, has passed away at the age of 99. We were actually just talking about him a couple of weeks ago, excited for him that he would turn 100 on January 1st. He was a New Year's baby. And so anyway, my heart is quite sunk at this moment. I'm going to do my best to get through this presentation as adequately as I can. Probably good to take my mind off of it a little bit, but many of you know that I have a fairly close not necessarily a relationship, but a special place in my heart when it comes to Charlie Munger and Warren Buffett, having gone back to the Berkshire Hathaway meetings ever since 2005. My first year was 2005. I've gone back there every single year since then that they've allowed an audience. There were 2 years that they didn't allow a live audience because of COVID. So that means that in the last 18 years, I've seen Charlie Munger 16 times, and not just in passing. Of course, you kind of feel like you get to know him a little bit more than the average kind of, celebrity or business person or sports athlete or what have you, because they're up there sharing their life, their thoughts, their opinions on the thing that you care about, in my case, investing, for 6 hours in a question and answer session. That's not a normal kind of back and forth that you would have with another type of a celebrity out there. So for 16 out of the last 18 years, I've got to sit at the feet of Charlie Munger and Warren Buffett and try to learn and soak up as much knowledge and wisdom as I could over those years. Of course, putting that into perspective is interesting as well. I mean, heck, there are family members, including my older brother. I don't think I've seen him 16 times in the last 18 years. My younger brother I have. But point is, it's impactful to me. And there's a lot of us that Warren and Charlie have impacted over the years. And so, my heart goes out to Warren, of course, tonight as well. Warren is 93. And he has worked with Charlie basically for the last 64 years. They've known each other. They both happened to grow up in Omaha, but they didn't know each other when they were kids. They discovered one another when they were in their 20s and 30s. But anyway, I hope Warren's doing okay tonight, because, boy, that type of a relationship has got to be as close as almost like a spousal relationship between those two, and the back and forth that they've had over the years. The meetings in the future aren't going to quite be the same. I always appreciated Charlie's humor more than anything. He had a sharp tongue. He kind of came off as the grumpy old man, but he did it in a lighthearted way, where he was getting a lot of laughs out of it. You could tell he wasn't mean-spirited about it, and I think a lot of people really appreciated how quickly he could come back with a line or two. So I'm certainly going to miss his humor, and definitely going to miss his presence in the business world. We don't have a lot of people like Warren and Charlie out there. We've got the mega billionaires of our current world in the giants of the technology space, your Jeff Bezos and Elon Musks of the world. But you don't have the giants necessarily directly within finance, which of course is what a lot of us who listen to this YouTube video, and myself and others, care about. And so we will be looking towards others to hopefully fill that role. But I don't think there's anybody that's going to be able to exactly replicate what Charlie has offered the business community over the last several years and decades. And I know for one, I am going to miss him deeply. So anyway, just wanted to share that because I know many of you probably are thinking about it as well, and wondering what my thoughts are on it. And we'll do our best to honor him moving forward. Remember, Charlie was always big on education. He always has a lot of quotes about waking up one day smarter than you were the next day, and even doing it with baby steps. He used to joke that he was a book with legs, is how he would describe himself, because he was constantly reading and trying to improve his own life. And he was really quite a Renaissance man as well. He had his hands in a lot of different pots, even more so than Warren Buffett, I would say. Buffett is probably a bit more well-known and well-regarded within the investing world, but Charlie is about as smart of a guy as you will ever find out there, and he has dabbled in a lot of different areas. Remember, he was once upon a time a lawyer before he became an investor. And he's dabbled in architecture and a number of things. He is just a very well-read individual. And like I mentioned on Twitter, this last year when we went to the Berkshire Hathaway meeting here just in May, I decided intentionally to pull my 8-year-old out of school, which probably is not a great idea for a dad to do traditionally, but I really wanted to bring my son to the Berkshire Hathaway meeting for his first time ever this year. He's at an age where I think he'll be able to remember it and appreciate it and all that kind of stuff. Some of you know that my son's middle name is Warren, so I'm an Uber fan when it comes to Berkshire Hathaway. And all these years I had usually been going on my own back to Omaha. My wife would join me every so often, but I'd meet up with my friends from Omaha there and different things like that. But I had never taken my son before. And so this year I decided, you know what? What's he going to remember many years from now? That extra day that he was sitting in a classroom, or that day when he got to spend, time at the foot of one of the true great teachers of our era in the business world, Charlie Munger. And boy, in hindsight, looking back now at that decision, I'm very, very thankful that I gave him that opportunity, because had I just waited one more year, of course, Charlie wouldn't be there. So anyway, thinking about Charlie, thinking about Warren, thinking about Charlie's family and everybody that he touched here tonight, and my hearts go out to you, and I hope that we can all honor him as best as we can. All right, let's go ahead and get into the traditional analysis now. And you can see here is our heat map for the S&P 500 here today, and it was a bit of a mixed session, as you can see. I would say that today was one of those days where you probably were carried just a little bit by the Magnificent Seven. The S&P 500 closed above the flat line just barely, and a lot of that is probably credited to the fact that Tesla was up 4.5% as one of the biggest winners within the market. Microsoft also had a solid day, up over 1%. Meta had a strong day, up over 1%, and then Alphabet up 0.5%, and Apple up 1/3%, also chipped in on the bullish side of the ledger, which basically means that Nvidia being down 0.87% and Amazon being down 0.47% were the only two down movers within the Magnificent Seven. And with those 7 companies holding as much sway as they have, then of course there's going to be a slight edge for the bulls in today's session. You can see that there were some other big movers out there, including Palo Alto Networks up 3%. PayPal had a nice day, up 3.67%. I did notice that Newmont Mining was one of the best performers in the S&P 500 today. Remember, Newmont is the only pure gold company in the S&P 500, as many gold companies are headquartered outside of the U.S., so they have a unique distinction in that regard. They were up 6% here today. We've been noting the strength in gold in these here videos for the last several weeks. For some reason, I was thinking we spotted gold in them thar hills, the way that I said that a second ago. But we've been discussing the strength in gold in these here videos for the last couple of weeks, and now you're starting to see some of that strength go from gold bullion itself into some of those miners in the case of Newmont here today. So those were some of your bigger movers on the upside of the market. On the downside of the market, Disney kind of stands out to me. It was down nearly 3% today. I believe they had an investor day today, as we've just recently crossed over the 1-year anniversary of Bob coming back to Disney. We also have GE Healthcare that had a tough day today, down 4%. There were some industrials that struggled today. One that I noticed was ODFL. Remember, we actually have a bearish trade on that going on right now, so I was happy to see that that one was on the negative side of the ledger. Then again, we also have a bullish trade on ACGL, which is one of those insurance companies, and they were largely down today, so a bit offsetting in that regard. But anyway, I did notice that a handful of those industrials companies seem to be not necessarily nosediving, but just really kind of struggling to continue their advance. Remember, a lot of stocks are up tremendously in the month of November, and it just makes you wonder how much more gas they have in the tank, and it seems like some of them are starting to stall out just a little bit there. Let's go ahead and get on over here to the main part of the platform now and pull up chart 4B. This is our market outlook foregrid that we use here that will show the market forecast technical indicator under each of the 4 charts. And a reminder for those of you that are premium members of Market Scholars, and hello to those of you that might be new that took advantage of our Black Friday sale here recently. Remember, you have access to all 50 plus of the customized charts that you'll see David and I using in our classes and in these presentations. This foregrid here is chart 4B, and it's going to have a unique function that will show you through the background of the chart what the current posture is of these various indices that we have pulled up. So when the background color is green behind the current candle, as it is with all 4 of our charts here today, no surprise, our intermediate posture remains strongly bullish, and that has been the case for several weeks at this point, so that should not come as too much of a surprise. Let's go through the data. We had S&P 500 up 0.1% today. So again, a very modest advance, but it was an update nonetheless, and it's going to be interesting when we go back and we finally put a ribbon on the month of November to see how many up days versus down days we had this month. I mean, it has been remarkably persistent towards the bulls. You rarely see an entire calendar month with very few days where the market was down, and that is what we are in the midst of right now. Of course, over the last week or so, the up advances haven't really led to much, not anything remotely close to what we saw in the initial push of this market right there at the end of October and into early November. A reminder of what kicked off this massive rally that we're in the midst of right now was those oversold cluster signals on the S&P 500. We had 2 of them in a row with those little green dots there, letting us know that we had back-to-back cluster days where the green, the blue, and the red lines were in the lower reversal zone on the same day. And that is exactly what kicked off that rocket ship to the upside. So note to self, if you haven't noted it to yourself in the past, when the S&P 500 gives you oversold cluster signals, it's worth sitting up and paying attention to. That has been a remarkable rally. You can see here that the Dow Jones was up 0.24% today, so it did a touch better than the S&P 500. You see that NASDAQ Composite was up 0.29%, so it did even better than both the Dow and the S&P 500. Remember, the NASDAQ is where you're going to have a higher concentration of tech stocks. And with those tech stocks that I rattled off before from the Magnificent Seven and even companies like Palo Alto Networks, those were strong performers today, so it boosted the appeal of the NASDAQ. And then the Russell 2000 was actually down today. It was down 0.47 or actually 0.46%, and has been a bit of a laggard, compared to the mega cap world that we've been living in here in 2023. So you'll notice that on the chart, within the last week, we've had a new 3-month high on the S&P 500. We actually had a new 3-month high today on the Dow Jones Industrial Average, and we had a 3-month high on the NASDAQ Composite within the last week. But with the Russell 2000, we cannot make that same claim. We are still a long ways away from the 3-month high back here on September 1st. So it remains a bit of a laggard in this market. Another way to identify that would be just to look at the intermediate readings here in the green line, and you'll notice that or in the green, not necessarily line, but the green label, it says 82.71 and falling for the Russell 2000. Now, we still consider that bullish because it's in the upper reversal zone, which is basically 80 and above. So whether it's falling or rising, we would give it kind of that grace period to consider it bullish. If it falls below 80, then we start thinking of it as bearish once again. So that's a possibility here in the future, but right now we're not quite there. But the point is, you can still get a sense of where the strength is, and with Russell 2000, 82 is much lower than the reading of 94 on the NASDAQ Composite, 97 on the Dow Jones Industrial Average, and 96 on the S&P 500. Remember, those numbers do not go above 100. So to put that into perspective, those other three kind of mega cap oriented indexes are much stronger at the moment than the small cap Russell 2000. It's not that the Russell 2000 is doing poorly, it's just having a hard time keeping up with a very, very strong rest of the market that we've seen, especially here more recently. I should point out that the Russell 2000 does have the distinction today of having what's known as a bullish intermediate confirmation signal. Remember, that exists on the market forecast technical indicator when you have the green line in a bullish posture, which, as I mentioned before, because it's above 80 at the moment, we would consider it to be bullish posture at this exact moment. So on a day when you have a bullish posture with the green line, the red line is in the lower reversal zone, which it is right now, just barely. Remember, the lower reversal zone on the market forecast is at 20. And so you can see in the label here on the Russell 2000, the momentum red line is at 17. So you have that combination that presents a bullish intermediate confirmation signal. You even have the blue line where you like to see it. You've heard David and I mention in the past that ideally you'd like to see the blue line between 20 and 50, and that is where we find it right now. So this is actually a better setup than would be the case otherwise for the bullish intermediate confirmation signal, which, remember, is kind of a buy the dips type of a mindset. It's basically looking for stocks, or in this case an index, that has a bullish intermediate posture but has a momentary sell-off, and we have had a 2-day sell-off in the Russell 2000. It hasn't been violent by any means, but nonetheless, you're getting a slight discount on your opportunity to buy it than you would have, let's say, 3 days ago. Let's go ahead and take a look here now at our 3 green arrows setup, which will be chart 4D. And as we look at this chart setup, a reminder that the background colors will determine whether we have what's known as a bullish, or not a bullish, but a 3 green arrow signal, which you can think of as bullish. So it's slightly different than the last chart setup that was kind of focusing its efforts on the market forecast technical indicator. This chart 4D will focus on 3 different technical indicators, including the 30-day moving average, the MACD histogram, and the stochastic. And when you have a green background color behind the candle on this particular chart setup, as we do in all 4 of our charts cases, it does mean that we have a 3 green arrows signal on all 4 of these here at the moment. So price in this case is above its moving average, which for all 4 of these charts, the moving average is rising as well, which is even more bullish than if the moving average would be falling. We also have a green arrow on the MACD histogram because the MACD histogram is crossed above the 0 line, which is telling us that there is bullish momentum within the market. Now keep in mind that MACD histogram is rolling over, and you might be within just another day or so of seeing a red arrow creep in onto the MACD histogram here. It's not necessarily because price is tanking. It basically is just a reflection of the acceleration of momentum. In this case, perhaps the deceleration of that momentum, because like right over here, when the S&P 500 was pretty much going straight up day after day, remember that was in the midst of an 8-day rally, that's when you've got these gray bars building on the MACD histogram. But as this market advance has continued to march higher, notice that the advance has gotten slower and slower and slower, and now it's at a snail's pace. So that's the reflection of those green bars turning into now these gray bars. And as you're getting so close to the 0 line on the MACD histogram, chances are very high that you're going to get a red arrow there, perhaps as soon as tomorrow. And then on the stochastic, we do still have the green arrow as well. It's a little harder to see that, so let me maximize and show you a little bit easier here that the green arrow on the stochastic exists as well. Remember that the green arrow on the stochastic is suggesting that price is trading near the high of recent price ranges, which is also a bullish feature. So all 3 of those most recent arrows are green for the S&P 500, and all 3 of them are green for each of the other 3 indices right now as well, which is another way of, saying that this is a reasonably strong and bullish market we're in the midst of here at the moment. Of course, this is a bullish time of year as well. Once we entered into November, we entered into the market's strongest 3-month period traditionally, which is November, December, January. And so November, we can pretty much put a check mark next to that. That's certainly shown through for us very nicely as a bullish month. What do December and January have in store? Of course, that's anybody's guess, but at least we do have some positive momentum behind our trading here at the moment. Let's take a look at our 1040 crossover method chart now. Remember, this is going to be a longer term chart now. The other charts that we've looked at thus far have been of the 3-month daily variety. This is a 3-year weekly variety where every one of the bars represents 1 week in time. So as we look back over the last 3 years for each of these 4 different charts, you can see that it has largely been a bullish period from exactly 3 years ago. Where you can't really get away with saying that is the Russell 2000. Three years ago on the Russell 2000, you were slightly above where it is right now. So you actually are down 5.5% on the Russell 2000 over that period of time. But the S&P 500 is up 23%, Dow Jones is up 17%, and the NASDAQ Composite is up 14%. So at least you have some positive gains out of the decision to get involved in the stock market 3 years ago, as opposed to other people that are making decisions like putting their money in their mattress or maybe a CD down at the bank or what have you. Markets do tend to go up over the long haul. This has not been the strongest 3-year period we've ever witnessed, because it's largely reflecting the pullback that we experienced last year. Remember, last year was a bearish year in the market where the S&P 500 from high to low was actually down more than 20%. So really what we have in this 3-year period that we're looking at here is one really strong year, which happened to be the first year, followed by a bad year, which was last year, and then this year you can kind of think of as just the recovery from last year's losses. So net, really the entirety of the 3-year gains is almost a direct result of year number 1 during that particular period. But throughout history, you will notice that it is very rare for the stock market to close lower in back-to-back calendar years. I remember we had a lot of conversations about that at the beginning of this year, and a lot of people didn't want to hear it because it felt a lot more bearish at that time, and it felt like we were going to be stuck with a tough market for a lot longer. But, as we now look at this with a little bit more of a, clear-eyed perspective, so to speak, we can see that this year was actually a pretty reasonable advance, at least from a market cap weighted perspective. It's been a little bit more challenging on a equal weighted basis. Nonetheless, we are a long ways off of the lows, and I think that is something that we can be thankful for. In terms of how do you read these charts and what the background colors mean on this chart 4C here, the background colors will determine whether we have what's referred to as a golden cross or a death cross, using the two different moving averages you see in front of you. The orange line is a 10-week exponential moving average. The blue line is a 40-week exponential moving average. Some of you who use daily charts might also refer to the golden cross and the death cross when you are using a 50-day moving average and a 200-day moving average. But if you convert those days into weeks, it's basically the same thing as a 10-week and a 40-week. So it just depends on how you want to load it up. But in this case, it's the weekly bars or candles that we're looking at. So as you can see, with 3 out of our 4 charts, we do have a green background. We have that with the S&P 500, we have it with the Dow Jones Industrial Average, and we have it with the NASDAQ Composite. And what that means is that we have a golden cross at the moment using the 10-week moving average versus the 40-week moving average. Remember, the 10-week is going to move much more quickly because it's much more sensitive, because it covers a smaller amount of data. And what you want to see is a burst of energy in the short term, and that's going to be measured by the orange line more than it's going to be measured by something that goes further back in time, like the blue line in this case, which measures 40 weeks worth of data. So when the more sensitive line is above the less sensitive line, it's telling you that there is a stronger bullish push in the short term that is creating that sensation, and therefore it is a more bullish feature to the markets. With the Russell 2000, you will notice that it is the only one of the 4 that has a pink background color, and as you can probably imagine, it's exactly the opposite. In other words, we have the background color is pink because we have a death cross. We have the orange line below the blue line in this case, telling us that sellers have been more aggressive than buyers in the short term, and that is being reflected in how those moving averages are being positioned. So, while we've had a clean sweep of bullish postures on the daily charts for the market forecast technical indicator, and we had a clean sweep on the daily charts of the 3 green arrow status, we don't quite have a clean sweep of bullishness here on the further back charts, where we have the Russell 2000 messing that up for us there with their slightly bearish posture. But you can see that orange line, so let me right click and maximize this so you guys can see this a bit better. The orange line is tilting higher, and that's a reflection of the bounce that the Russell 2000 has had over the last month. So it is possible that if we continue to have bullishness into the end of the year, we might be able to see that orange line cross up and through that blue line, maybe towards the end of this year or maybe at the beginning of next year. Again, assuming that the bullishness that we're currently in the midst of continues. So let's keep our eye on that possibility, but right now that's the only fly in the ointment. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations, especially here on X or Twitter, where David and I spend the vast majority of our time from a social media perspective. Thank you to the 110 people that clicked like for me last time around. As I'm looking at my background of my shelf there, I can see, of course, Charlie's bobblehead right there. And for those of you that don't know, many of those rubber duckies that I have back there are from the Berkshire Hathaway meetings that I take back, and one of them is supposedly Warren and one of them is supposedly Charlie. So I'm putting my mental energy on them a little bit more here today because of the sad news that we heard a little bit earlier. And again, there's the picture of my wife and my son having that opportunity, in this case, to hold Charlie and Warren in what they refer to as Squishmallows. And I had never heard of that company before, but for those of you that are parents, you're probably wondering, where has Brandon been? He's been under a rock. The Squishmallows are all the rage with the kids, and I found that out in a big way when we went back to the Berkshire Hathaway meeting, since they had a booth set up there at the meeting. So anyway, we'll always have our memories, even though Charlie is no longer with us here in this world. Anyway, thank you to the 110 of you that did click like for me the last time around. As I always say, as long as we're up and over those triple digits, 100 or more, I'm happy to do a full-length video for you, even when my heart is not fully into doing that video, as I am today, as I probably would rather be doing something else right now. But that is my commitment that I make to you, because I know many of you are committed to me in helping support these presentations. So I want to be a guy that you can rely on and count on, and this is my commitment to you. So thank you to the 110 that stepped up for me and clicked like. Let's do some shout outs. Thank you to Eugene. Thank you to Roger and to Eric and to Richard and to Walter and to Brandon and to John and Stephen and Vince and Ashok and Judy and Mr. Erpenbeck and Thomas and Dr. Bob and Jan and Surendhar, Irene and Ken and Bruce and Minda and Yield Curve Control and Marty. By the way, hello, Marty. He's our famous meteorologist. If you are in the Rochester, New York area, make sure you say hello to Marty, as he's one of our market scholars, but love seeing his work out there as well. And thank you to Ron, and thank you to Vernon and Roger and John and Dan and Sandeep and Ryan and Randy and William and Douglas. The list goes on and on and on. Can't get to all of you, but I do appreciate each and every one of you. Thank you so much for taking the 5 seconds out of your day to help support David and I in this quest of putting this free content on YouTube for you. Let's also have a little chat here about the sector selector. A reminder that this actually gets updated on Friday evenings, and so it is a couple of days stale by now. Of course, we do use it first thing Monday mornings in my top-down trend trading class, and we certainly get benefit out of doing that as well. Last week, as one example, we were able to buy a financial stock that is already up 18% in just over a week, basically a week and a day at this point. That doesn't happen normally, so I don't want to make the impression that it does, but every so often your tools can hit right, and we teamed this tool up with our stock selector tool, where we were able to make a selection that allowed us to have a pretty nice little winner there in the financial space, knowing that that sector is in favor here at the moment. Now, as I mentioned to my premium class yesterday morning, there's not a whole lot to report, because as you can see, the top 5 positions are all exactly the same as where they were last week. So pretty much the same trends are holding true. And part of the reason behind that is likely, remember, last week was a unique week in that we only were trading for 3.5 days because, of course, Thanksgiving was on Thursday all day, and then we kind of had a half day on Friday. So that's probably part of the reason there just wasn't as much time or days for big movements to take place, and therefore everything kind of just held the way that it is. So we continue to see a benefit on a relative basis by focusing our energies on technology, financials, industrial, and communications. At the bottom, you have more of your defensive and interest rate sensitive areas that continue to kind of stay in the back seat for the moment. All right, let's get back on track with our normal analysis of our 12 grids now. Back to the Thinkorswim platform. And I should also mention real quick, I did bring this up in class yesterday morning, but many of you may not have gotten a chance to see that yet, even those of you that are our premium members. I did make a big update to chart 1A over the weekend, so you'll notice that the new date on that one is November 25th, 2023. That is not just one of those small changes. This one was a pretty dramatic one. If you want to know the details of those changes, watch my recording from yesterday morning's top-down trend trading class. Again, that would be assuming you are a premium member of Market Scholars, where you have access to all 50 plus of these charts. But normally I don't make a comment about that, because usually the changes aren't particularly big. But this time around, this was a pretty large change that took place on chart 1A. So if you weren't in class yesterday and you're a premium member, I would encourage you to get the shared links that, of course, you can find on our tools tab on our website and get those re-imported into your platform if necessary. Anyway, back over here to our traditional approach now. Let's take a look at our asset class 12 grid, and this will be chart 5A for those of you that are following along at home. So you'll notice here that we have quite a few green charts on the board, which means that we have more bullishness than bearishness amongst these 12 entities or asset classes. And even better is specifically which ones are pink. As I've been explaining here quite a few times, especially more recently, when we have the US dollar that's bearish, and oil that's bearish, and the US Treasury yield that's bearish, those are all great things in general for the stock market. Now, obviously, those aren't the only things, so there are other things that will impact supply and demand of the stock market itself. But generally speaking, you would like to see it when the U.S. dollar is weak, because we have a lot of multinationals that make money in euros and yen and everything else. If you're McDonald's or Coca-Cola or Apple, and you need to bring those earnings back into a weaker currency, it's going to make it look as though your profits are bigger. If you're trying to bring those back into a stronger currency, it's going to make it look as though the profits are less. So with the dollar weakening, we're in one of those modes where those multinationals can benefit. Oil, of course, should be pretty obvious, especially those of us here in the United States. Most of us have vehicles. We have to get from place to place, as we are not a very condensedly populated country, right? We are spread throughout. As a guy who grew up in the middle of nowhere, South Dakota, I can promise you could go miles and miles without seeing a single person, right? There are some countries out there where it is incredibly populated, where they're building up, not out. But here in the United States, we have the blessings of a lot of land, and a lot of us need to drive from place to place. And so once every week or so, when we're filling up our gas tanks, in many cases, we recognize the difficulties that come with a high gasoline price and how that impacts our own personal finances. Well, take that concept and multiply it tremendously, and think about how oil prices will impact a wide variety of businesses out there, whether it's transportation related or whether it's just the manufacturing of plastics. All that has oil in it as well, right? So anyway, when oil prices are high, that pinches profits for a lot of organizations. When oil prices roll over, it helps expand profit margins. And that's kind of where we're at right now, with oil prices kind of in the dumps here all of a sudden. And then the 10-year Treasury yield, obviously, if you want to expand your business, you want to borrow money, you want to do it as cheaply as possible, not as expensive as possible. And here just a month or two ago, we were talking about the 10-year Treasury yield at a 5% level. Well, right now we're at 4.33% because we've gone down pretty much in a straight line for the last month. And that's really assisting many businesses as well with cheaper borrowing costs. So all three of those things are actually quite a nice little boost to the stock market in general. And so, we're thankful for those trends shaping up as opposed to the opposite. Remember, there were a lot of times last year where we saw the exact opposite of those three things. US dollar was strong, oil prices were going through the roof because of Russia, Ukraine, and then, 10-year Treasury yield was going straight up because Jerome Powell was trying to fight inflation. So it's nice that when we're on the other side of those dynamics and we can see the benefit that we've had with the stock market basically going straight up for the last month. And that's not just here in the United States. We've had the foreign developed markets going straight up for the last month, and even the foreign emerging markets going straight up. By the way, did some of you catch Pinduoduo today, ticker symbol PDD? That thing is looking explosive. It was up 18%. So I didn't show you that on the heat map previously because as a Chinese company, actually they may have headquarters in Ireland these days from what I understand, but nonetheless, it's a foreign company, so it's not in the S&P 500, but my oh my, what a breakout move that was today. That company, I recently learned, owns Temu as well. And Shein is about ready to do an IPO here somewhat soon as a Singapore company. And for those of you that don't recognize Temu or Shein, you likely will sooner rather than later, as both of those companies are having tremendous success, basically cutting out the middleman, allowing somebody to buy merchandise directly from factories. And it's been quite a success from my understanding. I have actually never done that myself, but I do know that a lot of people, especially people who are buying clothing and fashion and things like that, they're really benefiting from that. So anyway, that was one of the big story stocks of today, Pinduoduo, ticker symbol PDD. But you can see that it's not just China that is doing well today. EEM, which is basically the emerging markets where you can think of China, India, Brazil, Mexico as a category, was up nicely today. It was up way more than the U.S. market and way more than its foreign counterparts in the developed areas. EEM was up 0.84% today, whereas EFA, the developed foreign stocks, was only up 0.03%. So quite a bit of excess outperformance there out of the emerging markets today, perhaps on the backs of that enthusiasm for Pinduoduo. By the way, I should have mentioned as well on those two bottom charts when we were talking about those bearish ones, the US dollar and the 10-year Treasury yield both ended today with oversold cluster signals. We'll see if that leads to any sort of a reversion to the mean in the short term, a little bit higher. But remember, when we have those reversion to the means, what's important to recognize is that the trends are oftentimes not broken. It's just kind of a miniature relief rally, and then the trends are kind of sticking after that. So keep that in mind too, in case we do have some sort of a rally in those asset classes in the short term. Don't make the assumption that they're automatically going to just go ripping higher like we saw a few months ago. You're probably going to have some folks step in and sell those bounce opportunities if they do emerge. Should also bring up gold. So when the US dollar goes lower, gold, which is priced in US dollars, tends to go higher. And take a look at this beautiful breakout here on gold. When I was with you last week, we were talking about the nice bounce up and off of the rising moving average, but we had not yet cleared that resistance point. Well, with the last 2 days worth of trading, not only have we cleared that resistance, we cleared it nicely. It hasn't even been a question mark, right? A lot of times you kind of hesitate at the moving average or a resistance area or whatever seems to be blocking you at that moment. In this case, there was no signs of slowing down. It was just a straight up move out of gold for the last 3 days. So again, going back to what I'd mentioned before about Newmont Mining being one of the strongest performers in the S&P 500 today, this is part of the reason behind that. Gold had an outstanding day. Gold was up over 1.33%, and is at a new 3-month high. Obviously, bullish posture and above its rising moving average there. With the 10-year Treasury yield falling, those are days where typically you will find bond prices rising. Remember, bond prices and yields are oftentimes inverse to one another. So the long-term U.S. Treasuries were up 0.2% today. Foreign bonds is up 0.29%, and high-yield bonds is up 0.44%. So strong days across the board there. take a look at foreign bonds. The combination of interest rates falling and a weak dollar, remember that's a double bonus for foreign bonds, they are at 3-month highs here all of a sudden. So really impressive move there. You'll see here that the high yield bonds do have an overbought cluster signal as of today. Not sure if that'll lead to anything, but at least be aware of it. All right, let's now take a look at our sector 12 grid, chart 5C for those of you that are following along at home. As we pull this up here, probably the first thing that stands out to you is that we have just one chart that is in the red or the pink at the moment, and that happens to be energy. Remember, that was the case here a week or two ago as well, where they were the only sector with a bearish posture, a bearish intermediate posture. And as I showed you there a moment ago, with oil prices struggling recently, this should not come as a surprise that energy stocks are following suit. While there are some unique examples within the energy patch that don't necessarily have to be completely correlated to oil prices themselves, it is also true that the vast majority of energy stocks are that way. So you can assume that if oil prices are going up, all else being equal, the vast majority of oil stocks will be going up. And of course, vice versa as well. And we're in one of those vice versa moments with oil prices struggling here. So again, I'm not going to complain. In a lot of ways, we're redistributing the money that would have otherwise been in the energy patch into other areas that are saving money on transportation costs and fuel costs and production and manufacturing costs and all that when oil prices are lower. So it's actually a benefit if you want to think of the oil stocks as a sacrificial lamb of sorts for the benefit of the rest of the market. You'll notice that of all the rest of the charts that are green, you do have one distinguishing element out of the healthcare area where the moving average color right now is yellow, and the reason for that is prices above a falling moving average. Now yesterday it was rising, so it was green for one day and it went right back to yellow here today. So there's a little bit of positioning taking place there within the calculation of the moving average. Otherwise, outside of healthcare, all the rest of the other green charts have green 30-day moving averages as well, telling us that price is above rising moving averages. That's not a bearish feature, right? That's a bullish feature. It's telling you that the average prices that people have been willing to pay for the last 30 days has been higher and higher as the days go along. Usually, if you're in a bearish mindset of a market, participants are not going to be willing to put up with that. So it's a sign of the health of the market and sign of risk-taking within the market that is alive here at this moment. Now, in terms of looking at those green charts and determining which ones are the strongest, I would probably point out that technology would certainly be my choice in terms of strength. As you can see, we are very close to a 3-month high. Communications would be in that discussion as we're only 3 or 4 days off of a 3-month high. Financials, we're only 3 days off of a high, actually just a couple of days off of a 3-month high. And then I would also throw in a new sector, right? The other ones we've talked about plenty when you've been listening to my presentations in recent weeks. So talking about technology, communications, financials is nothing new. But what is new is real estate is kind of coming along here. I mean, I'm almost afraid to utter it because as a dividend investor, I've been taking some lashings with a lot of these interest rate sensitive securities out there, but there's actually been a pretty strong push out of the real estate sector here recently. So we'll see if they can keep the good times going or not. You can see that we are at, let's call it 2.5-month highs on the real estate sector. So we still got plenty of overhead resistance that we've got to contend with, but hey, we'll start because earlier this year it just kind of felt like it was hopeless as it was lower highs and lower lows for an extended period of time. Here we can actually make the claim that we've started, hopefully, at least in the short term, a newer trend of higher highs and higher lows, right? We have a low here on XLRE, the real estate ETF, and then we have a higher low right here. We have a high right here at the beginning of November, and we have a higher high right now. So again, I don't want to make too much of it because that's a very small amount of pattern right there. But if there is going to be a more robust rally eventually, it's got to start somewhere. So who knows? Maybe this is the moment where we have a legitimate reversal in some of those interest rate sensitive areas. All right, let's now go ahead and take a look here at our trade setup for the day. And we'll take a look at the swing trading chart, which is chart 3A. And so 3A is going to be just focusing a bit more of its energy on the near-term blue line of the market forecast technical indicator and less so on the green line like some of our other charts. So I wanted to bring up ticker symbol APTV. Now, just a reminder, this trade was done while the stock market was open. I got it done about a half an hour before the closing bell today. And if you are a premium member of Market Scholars, another benefit that you receive with that education package is you get access to our premium Telegram channel as well. It is a private channel, so you cannot find it publicly. There are others that have tried to pretend they were us, so if you are seeing a Market Scholars publicly out there, it's not us. So just be sure you're careful with that. But if you are a premium member of Market Scholars, of course, we will give you the invitation to our private channel. And there we display which trades we're doing for our various classes, and in this case, the Market Outlook video as well. So not to suggest that you should take action upon that or anything like that, since we're not your advisors. We can't tell you to do anything with your money, but we figure it's probably worth it for you to at least have a slight information edge over the folks who are not premium members of Market Scholars and have to wait until maybe that night or the next day before they find out which trades we're doing. So anyway, I've already done this trade, and it is a bearish trade on this ticker symbol APTV, which is called Aptiv. I believe they are into like automobile parts and different things like that. Anyway, what kind of caught my eye with this one today, firstly, was looking at the blue line on the market forecast technical indicator, and you're noticing a series of lower highs kind of shaking out here on those blue peaks that I'm kind of circling with my mouse right now. And at the time when we have those lower highs, we are seeing higher movements in the underlying price action up above, right? So price is going up at a time when there's a deterioration on the underlying indicator. Sometimes that's giving us a heads up or a poker tell that not all is as well as you might assume if you're only looking at the Wall Street Journal and just seeing prices go up every day for this security or any other one that you're looking at. Whereas the technical indicators are telling us there's a little bit more of a disturbance in the force here. There's a little bit more to contend with. Now, whether it amounts to anything remains to be seen. But at least there's some evidence there that suggests that things are stalling out a little bit here. You'll notice that this stock was in a very obvious downtrend up until more recently, and that kind of culminated with this oversold cluster signal here that led to a reversion to the mean bounce. And then for the last 3 days or so, it has refused to get up and over that moving average. You'll notice that that moving average is colored red because price remains below a falling moving average, and that has been the majority color of this moving average for the entire 3 months here. You've had a little bit of time where it was yellow because price was above it, but even then, price barely got above it. It was just kind of like hanging out barely above the moving average. So this one doesn't seem to have a lot of bullish supporters. Maybe they'll show up here eventually, but at the moment, you'd like to think that those who have been kind of in charge of this chart, so to speak, have been the sellers, not the buyers. And you can see up above here, you've got red labels across the board telling us that we have negative performance on all of those time periods. And this is, of course, occurring in a year when the stock market is up. So this has been an underperforming security. You can see it's underperforming the S&P 500 over the last 3 months of this chart as well. So figured it might be useful to add another bearish trade into the portfolio. Remember, we have plenty of bullish ones. I've got an insurance trade on the bullish side. I've got a utility trade on the bullish side. I've got a CRISPR trade on the bullish side. I've got the sold put trades that I've done with T. Rowe Price and American Tower on the bullish side, whereas I only had two previous bearish trades on. And by the way, both of them are actually making money at this moment. So despite what has been a remarkably strong and bullish November, the two bearish trades that I have on for this presentation's purposes are actually profitable at this moment. Hopefully they stay that way. So I'm going to add a third bearish trade here with this one at the moment. What I did was I sold a bear call spread, and it was the January contracts, since I couldn't really get much juice out of the Decembers. Remember, one of the challenging things right now is that the VIX is really low, and that's kind of hurting our prospects for being able to get juicy credits out of it. So we do have some limiting aspects of it. But what I did was I sold the 87.5 call, and I bought the 90 call, and that generated a credit of 60 cents. And so my break even is this black line you see up here at $88.10. And as you can see, that would put us slightly above these three candles right before you had that gap down upon their earnings here. So if we do have a little bit of a rolling over effect that's taking place on the underside of this falling moving average, and this kind of either stalls out sideways or starts heading back into that downtrend where it came from, then that will benefit this trade. If, on the other hand, we're in the midst of a bullish time period for the market, or this stock gets hot for whatever reason and it goes above that black line, then we will end up losing money on this trade. And this was a 30% return on risk, as we typically shoot for, actually 31%, I believe. But anyway, the nice thing about the trade is we have defined risk. Remember, we're not shorting this company in the stock market where you have undefined risk or infinite risk. In this case, since we have structured it as a credit spread, we know what our worst case scenario is. And so we can position size accordingly. Okay, so that's what I had for you here tonight with Aptiv as a bear call spread, hoping that it rolls over on the underside of that falling 30-day moving average. All right, that'll wrap us up. Appreciate you stopping by and checking out the video. Again, condolences to all of the Charlie Munger fans out there. Count me amongst you. I hope everything's okay with his family and with Buffett and others that cared so deeply about a brilliant man in the world of investing. We will certainly miss him. Thank you for checking out the video tonight. If you got benefit out of this video, as always, I ask one simple request. Click like for me there on Twitter. Only takes 5 seconds out of your time. If we're up and over 100 likes, by the time I do the video again on Thursday, I'll give you a full hour-long presentation as I did here tonight. So we'll let you guys decide on that. Whatever you decide, again, thank you for checking out the video. Have yourself a great rest of the night, and we'll see you all real soon. Bye-bye.